On March 2, 2026, the morning after U.S. and Israeli strikes killed Iran's supreme leader, gold crossed $5,300 an ounce. Oil spiked 13% in a single night. Equity futures dropped 600 points before the opening bell. And then something happened that every model in modern finance says is impossible. As the week progressed, the S&P 500 recovered, not slowly, not cautiously, to essentially flat, despite an active shooting war in the world's most oil-critical geography. Despite the Strait of Hormuz, the passage through which 21 million barrels of oil move every single day, under direct threat. Markets should have collapsed. Every geopolitical shock model built since 1973 says they should have collapsed. Goldman Sachs's risk models say they should have collapsed. Every volatility desk on Wall Street was pricing catastrophe. They didn't. These two things are not unrelated. They are two visible parts of a single underlying story. Everything I am about to walk you through is visible in the CFTC Commitment of Traders reports, the BIS Quarterly Review on Cross-Border Capital Flows, the Federal Reserve's ZEET1 Financial Accounts Report, and COMEX registered vault inventory data. The reason most analysts don't see the full picture is not because it is concealed. It is structural. The pieces live in different regulatory systems, reported in different filing contexts, by different agencies with different mandates, and nobody whose job it is to explain markets is paid to connect all four at once. That is what I am going to do right now. If you are not subscribed, the next development in this story will reach you too late to matter. Here is what Bloomberg, Reuters, The Wall Street Journal, and CNBC all reported, and to be clear, they reported it accurately. Operation Epic Fury began February 28th. U.S. and Israeli strikes hit Iranian nuclear and military infrastructure. Supreme Leader Khamenei was killed. Brent crude surged 13% in its largest single-night move since the Gulf War. Gold crossed $5,300. Defense stocks, Lockheed Martin, Northrop Grumman, RTX, each posted multi-percent gains in pre-market trading. Airlines collapsed, the VIX spiked. Capital rotated visibly toward perceived safety assets. The mainstream narrative correctly identifies the Phase 1 shock pattern. It correctly notes that oil markets reacted to supply risk. It correctly maps the defense sector rotation. The coverage from every major outlet identified the winners and losers of the opening 48 hours with reasonable precision. What it cannot explain is the recovery. If the Strait of Hormuz faces real closure risk, and military analysts at RAND and the Institute for the Study of War both assigned non-trivial probabilities, equity markets should not have stabilized inside a single week. Not with $36.2 trillion in federal debt. Not with the Federal Reserve unable to cut rates because CPI is still running above 2.9%. Not with annual U.S. interest payments already exceeding $1 trillion. The surface story explains what moved on March 2nd. It does not explain why those moves did not compound. It does not explain who was on the other side of every panicked sell order. It does not explain why the gold move was simultaneously larger and more durable than the oil move. But here is what that explanation misses. And what it misses is everything. The global capital market has two distinct layers that most investors conflate. Conflating them is the single most expensive mistake you can make right now. Layer 1 is the market most investors watch. It is the equity price on Bloomberg, the crude contract on the CME, the VIX reading on CNBC. It is liquid, it is real-time, it is emotionally compelling, and it is the market where retail and leveraged institutional capital predominantly operates. Layer 2 is where the actual structural positioning lives. It is the CFTC Commitment of Traders data, published weekly, almost never discussed on financial television, which shows the net positioning of commercial hedgers versus speculative traders. It is the BIS data on cross-border capital flows, which shows, with a 2-week lag, where sovereign and institutional money is actually moving. It is the vault inventory numbers, the registered gold available for physical delivery at COMEX, which during the week of the Iran strikes fell to levels not seen since 2019. Let me give you the cascade chain. Level 1. On March 2nd, CME Group's percentage-based margin requirements automatically scaled with the surge in crude contract value. That is how the mechanism is designed. Forced liquidation began in leveraged crude positions within hours. Prices spiked, triggering margin calls on adjacent energy derivatives, which triggered more forced selling, which drove further price amplification that had nothing to do with actual supply disruption and everything to do with the structure of leveraged exposure. Level 2. That forced liquidation created a structural anomaly. Paper crude prices at their peak dramatically overstated the physical supply signal. Simultaneously, COMEX registered gold inventory, the gold actually available for delivery, not the gold in paper contracts, was declining at an accelerating rate even as the paper price suggested abundant availability. Level 3. Who was on the other side? The CFTC data shows commercial hedgers, sovereign wealth funds, and central bank proxies classified as commercial entities were net buyers during that exact window, not retail, not hedge funds, sovereign capital. Here is the hidden connection. This is not just an energy crisis, it is a monetary credibility test. The U.S. Treasury market and the gold market run through the same choke point, the credibility of dollar-denominated reserves. The geopolitical shock that retail investors were treating as an oil trade was, from the perspective of sovereign capital in Beijing, Riyadh, and Abu Dhabi, something else entirely. It was a procurement window. Who benefits from panic-driven liquidation at structurally suppressed prices? The institutions that were already positioned to absorb what distressed sellers were forced to vacate. On the evening of March 1, 2026, as the first strike packages were still being assessed, there was a room in Riyadh that mattered more to the trajectory of global markets than anything happening on the floor of the New York Stock Exchange. Mohammed al-Jadaan, Saudi Arabia's finance minister, was facing a binary choice that had no good outcome, only a less bad one. Saudi Arabia's Vision 2030 fiscal model requires crude above $80 per barrel to balance the national budget. Brent was spiking past $85, temporarily. The structural question was not whether oil would be high on March 2nd. The question was what happens to Saudi balance sheet projections in the scenario where the Strait of Hormuz disruption extends past 60 days. Saudi Arabia's own export infrastructure bypasses Hormuz through the East-West pipeline, but that capacity is 5 million barrels per day against total export requirements of roughly 7 million. The gap is 2 million barrels per day. At $85 crude, that gap represents roughly $170 million in daily foregone revenue. Per week, that is over $1 billion. The sovereign math changes fast. Inside the Saudi finance ministry, there were two camps. The first camp, aligned with Aramco's commercial planning division, was arguing for immediate acceleration of non-Hormuz export contracts and using the price spike to lock in forward sales at elevated rates. The second camp, closer to the Saudi central bank's reserve management function, was arguing for something more consequential, using the currency reserve cushion, the $475 billion in foreign reserves held by SAMA, to quietly accumulate gold-adjacent assets while Western leveraged participants were in forced liquidation. The decision made in that period was the second. Here is why that matters, and here is where this story crosses from financial analysis into something geopolitical. The Saudi central bank's reserve allocation shift is not a trade. It is a statement about which monetary architecture Riyadh believes will be more durable over the next decade. That decision, made quietly in a room you will never see covered on CNBC, is the single most consequential capital allocation signal of the post-strike period. Here is what received virtually no coverage in Western financial media, and I believe it is one of the most significant monetary developments of the past 2 years. In the 72 hours following the Iran strikes, the Shanghai Gold Exchange reported physical delivery volumes that were 340% above their trailing 90-day average, not paper contract volume, physical delivery, gold leaving vaults. This was missed almost entirely in Western coverage for a structural reason. The Shanghai Gold Exchange reports in renminbi, files under the China Securities Regulatory Commission framework, operates in a time zone 11 to 14 hours ahead of Western markets, and its delivery data is not integrated into the Bloomberg or Reuters real-time feeds that Western analysts use as their primary data inputs. The information existed. The architecture of Western financial media simply was not built to surface it. Now, the contrast quantification. The Shanghai Gold Exchange moved the equivalent of approximately 150 metric tons in physical delivery in that 72-hour window. 150 metric tons sounds like a gold industry number. Let me put it in a monetary frame. At $5,300 per ounce, 150 metric tons is approximately $25.5 billion in physical gold changing hands. In 3 days, through a single exchange, in a market that Western analysts were not watching. While leveraged Western participants were treating the price spike as a moment of maximum fear, Eastern sovereign and institutional participants were treating it as a procurement window. The price that the first group was selling into, the second group was buying through. That asymmetry is not accidental, it is structural, and it is not closing. I want to be precise here. The direct attribution of this buying to sovereign entities rather than large private institutions is an interpretation, not an established fact. But the scale and timing are not disputable. The data is in the Shanghai Gold Exchange's own public filings. On August 22, 1971, 2 weeks after Nixon closed the gold window and suspended dollar convertibility, French Finance Minister Valéry Giscard d'Estaing stood before the National Assembly and called the new arrangement an exorbitant privilege. He was describing the structural advantage that accrues to the country whose currency is the global reserve, the ability to run deficits indefinitely, to export inflation, to borrow without the discipline that constrains every other sovereign borrower. What he was actually describing, though he framed it as a complaint, was a system that every non-dollar sovereign was now fully at the mercy of. The structural parallel to today is not the surface similarity. Oil disruption, currency stress, geopolitical shock. The parallel is the mechanism. A reserve currency issuer running unsustainable debt loads during a period of geopolitical fracture, while non-dollar sovereigns make incremental decisions to reduce that exposure. In 1971, those decisions took the form of demanding gold for dollar surplus balances, which is exactly what de Gaulle had been doing for 6 years before Nixon acted. Today, those decisions take the form of physical gold accumulation during dollar-denominated panic events. I am not predicting a dollar collapse or a new Bretton Woods, but the underlying dynamic, non-dollar sovereigns systematically reducing reserve concentration risk during windows of Western market volatility, is not structurally different from what played out between 1965 and 1971, and what followed that period changed the architecture of the entire global monetary system. I want to give you a framework you can carry into every future geopolitical event you encounter. I am calling it the sovereign procurement cycle. It has 3 components. Component 1, the panic compression. Every major geopolitical shock produces a period of forced liquidation among leveraged participants, typically 72 to 96 hours, during which asset prices temporarily detach downward from their structural value. This is not a market signal. It is a plumbing event. It is the mechanical consequence of margin requirements scaling automatically with volatility. Component 2, the structural absorption. During the panic compression, well-capitalized, unleveraged participants, principally sovereign wealth funds and central bank reserve managers, absorb what the forced sellers are liquidating. This absorption does not show up in real-time price data. It shows up 2 to 4 weeks later in CFTC positioning data, BIS flow data, and exchange delivery reports. Component 3, the repricing. When the panic compression ends and the structural absorption becomes visible in the data, prices reprice upward toward the value implied by the sovereign buyer's behavior. not toward the panic low and not toward the pre-shock high, but toward the new structural floor established by the new ownership concentration. Apply this to the Iran strikes. The panic compression ran from March 2nd through approximately March 5th. The structural absorption, visible in the Shanghai Gold Exchange data and the CFTC commercial positioning data, ran simultaneously. The repricing is the phase we are currently in. Apply it to a historical event. The London gold pool collapse in 1968 followed exactly this structure. Panic compression, sovereign absorption, permanent repricing. The gold price never returned to the pre-collapse level. Every time you see volatility-driven forced liquidation in a monetary asset, ask, who has the balance sheet to absorb this? The answer tells you where the new floor is. Watch item 1. The variable almost nobody is naming is the key signal right now. COMEX registered gold inventory, not total eligible inventory. Registered. That is the gold specifically earmarked for delivery against open contracts. If registered inventory falls below 8 million troy ounces, it was at approximately 11 million before the strikes, the paper-to-physical spread will widen in a way that forces a structural repricing of the entire futures complex. Watch this number weekly. It is published every business day at approximately 3:30 p.m. Eastern on the CME Group website. Watch item 2. The Federal Reserve Bank of New York's custodial gold account data, published monthly. If foreign central banks are repatriating gold from the New York Fed's vault, as Germany did between 2013 and 2017, relocating 300 tons, that data will appear here before it appears anywhere in the financial press. The next release covers April activity and publishes in late May. Watch item 3. The Strait of Hormuz transit data from Lloyd's List Intelligence. Specifically, watch whether VLCC tanker transits fall below 15 per week. Below that threshold, the physical supply signal crosses from disrupted to structurally redirected, and the energy infrastructure trade I described earlier compresses in its window. Watch item 4, the next BIS quarterly review, published in late June, which will contain the first institutional quality data on cross-border capital flows during the March shock period. That document will confirm or challenge the sovereign absorption thesis with hard numbers. Whether the monetary rebalancing now visibly underway completes in 5 years or 20, nobody can say with confidence. The timing of structural transitions in reserve currency systems has defeated every forecaster who has attempted to call it precisely. What can be said is this: every data point from the 72 hours following the Iran strikes moved in the same direction. Leveraged Western capital sold. Unleveraged Eastern sovereign capital bought. Physical delivery volumes surged. Registered vault inventory fell. The sovereign procurement cycle ran exactly as the historical pattern predicts. 30 days ago, 600-point Dow futures drops and $5,300 gold in a single night. Today, equity markets near flattened gold holding structurally above $5,100. That is not resolution, that is a pause. The BIS flow data that will confirm or challenge this thesis publishes in late June. We will cover it the moment it is released. Subscribe so that analysis reaches you before the market has already moved.